Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems.
Zed Francis, welcome back to the Mutiny Investing Podcast. Right away, right at the top, plug away. Where can people find your website? Where can they find you on LinkedIn? Anything else?
Yeah, just www.convexitas.com. And then my name's Zed, Z-E-D, so that's probably one of 5 of them on LinkedIn, so that's easy to find.
But you guys post great essays to your site, but you also, I guess you repost them to LinkedIn, and do you put more content on LinkedIn than just your essays, or how do you set that up?
Yeah, no, we, between podcasts, TV appearances, posts, we definitely do the LinkedIn thing. Devin is, my business partner, is getting on me to actually utilize LinkedIn as a tool. We'll figure out if I can learn something new and if it's useful. But yeah, you'll see an annoying amount of us, I think, probably over the next year as we learn to utilize it.
Good. I look forward to it. And you, by the way, you walked right in my trap of saying that you guys are philosophically boomers, because you right away, I said, what's your website? And you said www. Like, did you want to start with HTTP when are people going to stop saying www. For their website?
Well, I mean, as soon as I get off my Netscape browser, maybe.
Why I wanted to bring you back on was a year in review. Wow, how unique. Everybody does their year in reviews, but I actually liked a lot of the comments you had about Q4 and what you were thinking about in 2023. So I wanted to bring you on to discuss some of those. And let's just start, I think, with more of the simple ones of Q4. You thought a lot of the action in Q4, especially in December, was from tax loss harvesting and then also RMDs. So let's just start. I mean, tax loss harvesting is a little more obvious than the RMDs, but let's just talk a little bit about both.
Yeah, I guess we'll kick it off tax loss harvesting. So obviously it was a year that anybody that accumulated additional assets in 2020, 2021 likely had the opportunity to do some tax loss harvesting, especially because there's enough names that move like dramatically, right? There's probably stuff in your portfolio that was down 90%. Hopefully only 20 basis point holding, but some serious moves. And so, yeah, I think that definitely puts some pressure on the broader market at the end of the year. And you can kind of see it on funny days. To me, my best example of, that tax loss harvesting must be happening today. Everybody has tools. The tools are getting better for tax loss harvesting, but I still think most people basically open up their brokerage account and then go to the column that says, gains, losses, and then filters it to the highest to the lowest, and they start at the biggest loss. And there was a couple of random days, kind of like the week before Christmas, where, Apple was down 3% with the NASDAQ down 50 basis points. And you're like, okay, this is the start of tax loss harvesting, because Apple is probably your largest holding, with it being the largest company, and it was down 20% last year. So surprise, surprise, it's probably the biggest dollar loss, not percent, but dollar loss in your account, and that's where people started. and so that was you can still kind of physically see it going on. So I think that's one side of the pressure that I think is reasonably talked about and is a real thing when there's not a lot of trading volumes that can actually, dominate to some extent. But I think the more interesting side is required minimum distribution from DC, defined contribution retirement plans. And the reason why I think it's less talked about and more interesting is it's just important now and hasn't really been that important before. So, 60s, 70s, 80s, slowly but surely, most folks transition from DB, defined benefit, to DC, defined contribution retirement plans. And so there's not a lot of, we'll call it legacy, money until more recently. And more recently, those folks with that transition into how they're saving for retirement are now becoming of retirement age. So it's just, 20 years ago, this wouldn't be a big number because there wouldn't be a lot of people retiring and the pot wasn't as big, but now it's like a pretty big number. So it's something you should start paying attention to as we go through the next kind of 20 years of folks actually having to, sell things, on the schedule that's mandated by the IRS, essentially. So the other piece that's interesting beyond it not really being a dominant player until more recently is it's the required minimum distributions are set at the account value at the start of the year. So say you're 82, I believe, is your actuary table says you're going to live 10 more years. So you got to sell a tenth of your assets every year. And so say you had $100. So at the start of the year, so it says, okay, you got to sell $10 worth of stuff, 10% of that $100 at the start of the year. But in 2022, it was obviously a year where pretty much all assets fell. So, your ag's down 20%, your SP's down 20%, so on and so forth. So your $100 is now $80. And you don't have to sell 10% of $80. You got to sell $10. It's set at that, price of the account value at the start of the year. So it becomes like a pretty material amount of liquidations that have to take place. And again, like if you don't do it, it's a 50% haircut, basically. That's, a forced tax upon you for not doing it. So you're doing it. You're doing it no matter what. There's no way to avoid it. But it becomes pretty darn material. And everybody kind of does it in a waterfall fashion. So depending on which custodian your assets are at, they basically pick an arbitrary day in December when they're actually going to process all these required minimum distributions. And it's essentially kind of between December 10th and like December 23rd, because nobody wants to work, during the holidays. We want it done before then. We also want to get it as close to year end as possible. So that's kind of your waterfall. So, those 2 weeks in the middle of December, I think they had a pretty, overweighting impact on the pressure in the market from these, thoughtless selling programs. The back side of it, which is, I think kind of possibly what we're experiencing, the last 2 weeks of right now is, people forced to sell those assets. They have to pay taxes on them, and now they have cash. And they might just go put it back into the market. You didn't have this windfall of cash. You don't need it for life expenditures right now. You might need it over the next year or whatever. But you probably have an over allocation to cash just naturally because you're forced to sell assets. And now it's in your taxable account, and you probably go redeploy it into the market. So it has, I think it affects both ways. A decent amount of pressure in December, forced liquidations, and then, hey, we got some cash, let's go put it to work, and you go buy back all the same stuff that you probably just sold.
There's so many things I want to highlight there because I actually love this subject. And like you said, it's not talked about enough. One of the things I want to highlight, like you said, it's not on a percentage basis. It's like an actual dollar amount, like on that $10 on the $100, an example. Like everybody thinks it's just a percentage. And what is my net assets at the end of the year? And it's a percentage of that. But like you said, no, it's much worse than that. And I think you and I have talked about, I think you think that constant selling pressure that you get from these distributions is similar to what we saw in December of 2018, where you just saw just this constant tick down in the markets. That's why we didn't see really a vol spike in December of 2018, and maybe not as much in December of 2022, because you just have it's just constant every day, that selling pressure over a 2 week period.
Yeah, the parallel between 18 and 22 is, your fixed income and your equities were down, right? So it's you didn't have that situation where your $100 is still $100 just because you had some, actual diversification benefits of holding different things. Everything's down, so that forces that $100 to in 2018 to $90, and in 2022 to $80. So definitely a parallel between those two Decembers.
But then part of it too is I think about often is, and you may disagree with me on this, but to me, we have just an N of one experiment when we're talking about these defined contribution plans, and thinking about, 401ks, self-directed IRAs, or whatever it is. And especially start when we're moving into target date funds now. Every millennial or Gen Z is only going to have a target date fund, really, is their only optionality. They maybe have 2 to 6 options at best. And so to me, we haven't actually seen what this experiment looks like. And like you're saying right now is once people are starting to reach retirement age, they have to have these required distributions, and we haven't really seen what happens en masse at really scale. And I really wonder about, especially, it almost exacerbates it with the target date funds, and you could speak to that as far as you don't get to pick and choose as much what you can or can't sell. And then, what happens if, we're underwater for a decade and people just getting pinged with these required distributions?
Yeah, no, I think the, broader wealth transfer that, everybody acknowledges is going to take place over the next 20 to 30 years is going to obviously move things substantially, and the more mechanical those movements are, the more disconnects they have the ability to create. So I would agree that having more and more rules-based investment guidelines, both in terms of how you're meant to do distributions and invest, will create bigger gaps in terms of we'll call it market fair value pricing from one day to the next. There'll be some, hairier things that show up that hopefully create opportunities for others, but it's not, fantastic for those individuals that have to walk down that path.
Do you think it makes any difference though? Like historically in any sort of retirement account, you had a lot of options or different things you were invested in. But now if you're in a target date, do you think that has a dramatic effect when you're going to sell off those pieces in December?
I don't think anybody owns anything that different ultimately, especially in those types of accounts are kind of more broad-based. It's like, what's the difference between a couple of mutual funds and a target date fund in terms of the underlying assets that they hold?
Right.
Not dramatic.
And then how do you think about, I was thinking about, like you're saying, this constant selling pressure, especially in December. Then, like I said, a lot of times they're just buying it all back in January. But then the countervailing force to that is, the boomers have these required distributions, but then millennials have these target date funds where they're just every quarter, they're just dumping money into their target date funds. And so you have pressures on both sides. How do you think about like the forces on both sides of that equation?
Yeah, I mean, us millennials don't make enough money to swamp
offset it
what the boomers have. So I don't think there's a balance necessarily. I think the boomers, holding 70-80% of global assets matter a lot more than the rest of us.
Speaking of which, how do you think about that, like wealth transfer? There was a benign argument that essentially Bitcoin could be a wealth transfer mechanism between the generations, in the sense that, like, as Bitcoin increased and eventually as institutions came into Bitcoin, that maybe the boomers were buying into Bitcoin at the top, right, when like the millennials were making, hopefully exiting their gains. I mean, obviously it didn't happen, not likely to happen, and who knows what's going to happen in the future. But like, how do we have that wealth transfer, and how much of a haircut does that wealth transfer have to take? Like you're saying, like basically target date funds, real estate, like for it to actually transfer, how do you what's the timing mechanism? What's the actual asset value? Like how much of a haircut to NAV are you going to take to like really transfer that wealth? And, we'll see how real that wealth is, I guess.
Yeah. I mean, it's like everything in life. Those with a ton of money probably don't take any haircut. They've created the correct vehicle to avoid both the tax man and friction from transitioning those assets from one generation to the next. But the rest of us folks definitely have a leakage to both the tax man and probably have some sort of friction. If most people, their main assets, their house, right? For an average person, okay, like that's going to be the mechanism that's going to transfer wealth to the next generation. Most likely the 2, 3, 4 kids don't want the house. So, okay, we've got to sell the house. Well, there's, not only a tax event, but a friction in the marketplace to eventually get cash on the other end for those folks. So yeah, I mean, I think there's going to be a lot of, choppy, interesting things that take place over the next 20 years as that event kind of unfolds.
Yeah, like I always like to say, you have to throw out like the 100-year backtest data on housing, especially if boomers are the first generation to own 2 to 3 houses. So not only they're trying to transfer the house, they're trying to transfer multiple vacation homes, and the kids don't want it, and everybody's forced selling. Like it's going to be really interesting to see what happens in those markets.
The kids might keep the ski house and Sandals Resort condo, but I think the house in the burbs gets sold.
The other thing you talked about December that I thought was interesting, at least in vol markets, is the idea around, in December, things were fairly benign on the month besides like FOMC meetings. So you had like extreme movements over like 1 to 2 days and then completely benign markets. So tell me about like this bipolar market that we saw in December.
Yeah, no, the most interesting thing in vol markets for December is effectively options were saying only 2 days mattered, and they were back to back. It was the CPI release and the December FOMC meeting. And start of the month, basically, if you were to just buy an at the money put, buy an at the money call, it was saying, we think the market's gonna move about 4% over the month. But if you were only targeting essentially those 2 days, trading that same option strategy, targeting those 2 days, it basically said like 3.6%. So it was the market was basically saying those are the only 2 days that matter, and then we're all gonna just go run off to vacation into the holidays and be fine. And so to me, that was the interesting thing, is to just take the other side, say, those 2 days might matter, but I actually want to own some convexity for all the other days. It just seems too cheap. And by happenstance, you never know if it's going to work or not, but that doesn't really matter. The pricing seemed wrong in the options, and obviously those 2 days happened. Were actually very benign. Ultimately, the 2 days everybody was focused on, and then the fireworks were the kind of following 6 to 7 trading days.
And like you said, you had to pay just in that month, you had to pay close attention to FOMC and CPI, but we'll get into that in a few minutes of like, what does that look like next year? How closely should, or do you think we should pay attention? But another one of the kind of curveballs I'll throw at you is like, there's been a lot of sound and fury lately about the 0 days expiration options and being over 50% of the market and everything. Do you think this is there anything to this? What's your take?
I think the exchanges are incredibly happy. Otherwise, I don't think it does much of anything. Main reason is just if an option, has only a couple hours left, it's no real risk. So it's not really moving marketplace. It's either 100 or a 0 delta. And guess what? People that are selling those options aren't really delta hedging them to go ahead and hedge that risk, because it's basically unhedgeable risk, or doing it with a linear instrument would be the incorrect way to hedge that risk. So, somebody that sells a bunch of those 1 day options, they're either just riding it out because they have enough other things in their book to keep it balanced, or, they turn around and go buy some of the same, they spread it, right? That's the only kind of reasonable way to go ahead and hedge that risk. So, ultimately, I think it's immaterial for option pricing, market movements, things along those lines. But the exchanges are very, very happy. They're going to lean into this. Not only going to have AM and PM every single day expiries, they'll start doing 15-minute increments.
That makes me think of two things. One, I'm trying to think. I think it was Horizon Kinetics that came out with the idea that one of the ways to hedge inflation was to invest in the exchanges. And maybe that works on the LME, the London Metals Exchange, or maybe some of the Japanese exchanges. But as you know, you're saying, basically a lot of the U.S. exchanges, Chicago and everything, are really just based on S&P E-mini options. So that doesn't really have anything to do with commodity inflation. So that's one way to look at it. It's that's where the bulk of it's all really around E-mini, SPX, and the options around those positions. But also, what do you think about the conspiracy theory that this is just the market makers trying to pin the numbers on SPX?
I mean, market makers don't like anything that's directional. It doesn't make sense for their bread and butter of how they like to make money.
Exactly. So the other thing that we'll start thinking about now, 2023. And in your letter, you talked about the story of 2022 is rates, but you think maybe the story of 2023 is going to be credit. And so this ties back into, how important do you think these FOMC and CPI numbers are going to be? And you've said that you believe that rates are going to be more range bound next year. What gives you that belief?
So first off, I believe fixed income is the most important kind of metric to pay attention to for all markets at pretty much all points in time. So it's not just 2022, Jason. For my entire career, I've been yelling at people it's rate stupid. That's the most important thing. So it's a big shift for me to say, okay, rates, put them in your back pocket, know what's going on there, but let's turn our focus to credit. My main reason for that is I do think that 2023 ultimately rates are going to be pretty darn range bound, because you have kind of two opposing forces that are going to kind of keep things in a, and it's a pretty wide range. 10s I think will be 3% to 4.5%. It's not 20 basis points wide, but after moving 400 basis points last year, it kind of feels like a reasonably tight range. And the two opposing forces are, I think, whether or not we go into recession, who knows? But, the economy's slowing. So you're okay, a slower growth world is going to kind of put a cap in yields. And so I think it's going to be tough for, tends to go above kind of 4.5% if, global growth is slowing. Like who the heck knows where to, but slowing. The other side of that, which I think is at least more interesting on my view, is I think the Fed is not going to adjust their stance. So that's kind of putting the floor, if you will, in the range in yields, because even if GDP growth is negative, if the front end of the curve has a four handle on it, like you're not going to be too far away from 3% and tens. The reason why I have a pretty strong belief that the Fed is going to kind of hold the line is credibility. What they care about more than anything else is being very important. They must maintain that importance and credibility, or else things don't really work to their liking. Because what I mean by that is, like, tangibly, they really only have two tools. They can move the Fed funds rate and they can buy and sell assets. And both of these things have, probably some effect on the real economy in the future, probably not a lot of effect on the real economy, immediately, and, some effect on asset prices, maybe somewhat immediately over the long term. But like those tools, they're not dramatically effective for, forcing change tomorrow. What is very effective at forcing change tomorrow is, we'll just throw it under the umbrella of forward guidance. Like the Feds speak, we will do anything to save the market. Like that carries a lot of weight, and that's an intangible tool. And to be able to utilize an intangible tool, you just have to have full credibility. You can't have anybody saying, "Oh, I'm willing to fight the Fed now because I don't think they can do it." Then it all falls apart. They must maintain that credibility. And I think the only way for them to truly maintain that credibility is to just stay on the path, say, don't fight us. We ain't, changing. Market, you're wrong. We're right. And I think they're going to be much more steadfast and be willing to make, a policy error to maintain that importance and that credibility. Why do I think that they're focused on this? Why do I think that they're actually nervous about, their credibility in the marketplace? Is developing market central banks had a rough 22. Kind of kicked off with the UK. Obviously, it started on the fiscal side of the house, making a policy error, adding stimulus in the face of inflation that created some problems. But the central bank over there had, nobody listened to their message, if you will. The market forces overwhelmed the central bank, and that's not a small economy or a meaningless economy. Like, this is a developed one that people take note on and say, like maybe these central banks are losing a little bit of control here. And then the other one that's still kind of unfolding is Japan. I think everybody was already kind of run off to the holidays when they made their shift at the end of December, but then kind of getting broken on their yield curve control, moving things from 25 basis points to 50 basis points of their target. The market instantly taking the 25 basis points and actually pushing it through. And frankly, they're tens in Japan, and JGBs have been trading above that 50 basis point target for pretty much all of this year, is again something that's making the Fed nervous. That another major central bank, people aren't listening to them right now, and are fighting their message is actually working and winning. So I think they'll do anything that they can to maintain credibility, even if it seems like a policy error, because that ultimately is more important to them for the long haul.
There's so many things I want to touch on in there. One is, and hopefully we'll get to a little bit more on the UK and Japan later. But credibility, this is the one I've never been able to wrap my head around, in the sense that, like, I never personally think about what is the Fed credible or not. And also, but then again, I'm not a Fed watcher. I also happen to have a general philosophy that they're more trend followers than being able to do anything in markets. You may disagree with that. That's fine. But then also, so do you think it's more like a Keynesian beauty contest of, like, if the market participants in aggregate worry about Fed credibility and positioning, then that's what you need to worry about. Not is actually the Fed credible. It's like, do people perceive them as credible? Is that what you're saying?
No, it's right. No, it's you need the people that move money to listen to them. And as soon as they stop listening to them, then the ability to use the intangible tool of Fed speak, forward guidance, anything along those lines, loses its effect. Meaning, like, if we actually get to a really bad situation, that the ability for the Fed to kind of put up the wall and be like, we'll save everybody, stop selling, that doesn't work anymore. and they will do anything to make sure that they still have that ability to influence basically market participants at a whim.
One of the things we heard in 2022 is like everybody's talking about, it's one of the most telegraphed recessions in history and people are positioned for it and everything. But then you heard people kind of banging on of like, yeah, but why are high yield credit spreads so tight? And so do you think that like lulled people into a false sense of security and we might see that start to break out a little bit in 2023 or?
Yeah, I mean, the first half when you said why I've gone from 15 years of saying rates, and I'm like, I think rates are actually going to be kind of boring this year, especially comparative to everybody's focus, and credit is where I want to focus my attention in terms of what it's saying about the market. And credit, as you mentioned, is incredibly tight considering what we've gone through in 2022, and most people thinking that slowing economy, potentially recession. These should be all things that says credit, it should be widening, and that obviously hasn't taken place. So you have like high yield, kind of like 50th percentile historical spreads. You have market IG about the same, like 40th, 50th percentile, and then you got long and IG at like 20-ish percentile. So like bull market, like incredibly tight. So one of the main things that has happened here, in my view, is just very simple flows driven, pricing, if you will, that's influenced credit dramatically over the last year and forcing it to be much tighter than, fundamentals could possibly argue. So there's two main ones on the demand side. All right. So I think a sneaky one is there's a decent amount of money that's been funneled from the government to union pensions as part of many of our $1 trillion acts that have been put in place over the last 2.5 years. And
just to highlight that, sorry, I don't want to interrupt you, but to highlight that really quick, because you were the first person I really heard talking about this, is the March 2021 COVID-19 relief bill had a section 89B that really affected union pensions. So I just want to highlight for people to know, like, this 89B rule is what brought a lot of this money into pensions, like you're saying, that's on the demand side.
Yeah. So, government topping up their friends' pensions. But of course, the government, when they give money, there's always rules attached to it. And the rules attached to it are essentially, they couldn't take this money and go buy Bitcoin. They needed to go ahead and invest in something that the government deems to be safe. And what does that mean? It means treasuries, investment grade credit, MBS. So it was auto demand of new money, being forced into those marketplaces. Another dramatic, increase in demand over the last year is public pensions too, but corporate pensions are incredibly well funded. It was a fantastic year for corporate pensions, and everybody's like, what the heck? Every single asset went down. Like, what the heck are you talking about? Well, a pension, there's two sides of the coin. You have assets and you have liabilities. Those liabilities are discounted at an A or better curve, meaning that if interest rates or credit spreads widen, but interest rates go up a lot, discount rates go up a lot, meaning the current present value of your liabilities falls dramatically. So, what happened last year, sure, your asset portfolio is down 20%, but your liabilities were down like 35% for an open pension plan, meaning you went from being underfunded to the average corporate pension plan is about 105, 110% funded. They're fully funded for the first time since 2007. So what happens if you're a corporate pension and you're fully funded? Well, you sell risk assets, you sell equities, you sell VCP, or pull your commitments to those privates. And then you buy whatever the assets that are the discounting mechanism of your liabilities, i.e. A or better credit. So it's a huge rotation from those, pensions acting honestly responsibly. Like, hey, we don't need to outperform our liabilities anymore. We're fully funded. We just need to perform in line with our liabilities. So they start buying the assets that are, the same mechanics of the discount rate of their liabilities, but they're also price indiscriminate buyers. Like, they don't really care. They just want the asset and the liability to move in lockstep in perpetuity, so they never have to think about the darn pension plan that's been a weight around their neck for the last 15 years. So the two huge, demand influences on credit that help get it to the place where it is right now. And again, I kind of said market credit, both IG and high yield is 50-ish percentile, and long end IG is like 20-ish percentile. That's why, right? It's like specifically pensions trying to buy long duration credit. That's where the real force is coming from on demand side. So surprisingly, we kind of have a funky curve that is like extraordinarily flat between kind of front end and longer end credit. Counterforce, not counterforce. On the other side, supply is also helping credit tighten. New issuance of corporate credit just goes up every single year since it became a real market in kind of late 60s, early 70s. Grows at kind of like a GDP plus nature. And 2022 was the first year, and I can't even think if there might not actually have been another year, but 2022 was actually net outstanding corporate credit sans financials fell. And I think it's actually pretty simple to think why they're not issuing a lot of additional debt. If you were a CFO of a corporate, you obviously issue debt for operations. Hey, we're building a factory. Like, let's go ahead and raise some money to go ahead and put those bricks in the ground. But they also, the last 20 years of really low interest rates, were probably borrowing money to buy back stock, to increase dividends, doing some fun financial engineering, and that's an easier decision to make when you're borrowing 10-year paper at 2.5% like you were in 2020, 2021. Now that you have to pay 6%, it probably doesn't it's not as easy to say let's go borrow a bunch of money at 6% to go buy back our stock. So they kind of stopped doing that piece of it. And if you only need to issue money for operations, you probably have about the same amount maturing as you do that you need to raise. And so it was quiet. So you had these, dramatic influence of increased demand of pretty price indiscriminate buyers, coupled with supply way undershooting expectations, simply because it probably didn't make a ton of sense to pay 6% to buy your stock back, or at least a more difficult, sell to a board to go along that path. And so it just forced credit tighter. Lots of demand, not a lot of supply. Well, what happens? Prices go up.
No, you segmented me perfectly to talk about the ladder of corporate paper, but like I want to tie that back into like in a weird way is like you were talking about the pensions and the reduction on the liability side. I just think it's always interesting to me is like for the last, decade plus, people have been banging the drum that the pensions are underfunded. They're underfunded. This is going to be a disaster. It's a slow moving train waiting to happen. And what always surprises me or makes me kind of giggle is that the hidden forces of the underlying markets tend to correct things more than people can. And so like, everybody always talks about wealth inequality, et cetera. The wealth inequality previously was at its high in the 1920s. Well, the 29 crash rectified that wealth inequality, right? Markets tend to mean revert and tend to take care of those things rather than politicians with a stroke of a pen. And so it was always interesting to me that everybody was, really upset about the unfunded pensions. And like you're saying, now they're overfunded. And all it took was, rates coming back up and a little bit of a protracted recession in 2022 to make that happen. And it kind of throws everybody out the window. So part of the one that where I'm tying it back in is understandably, a lot of people were really banging the drum previously, like they can't raise rates, because if you raise rates up to 2 to 3%, you're going to absolutely break the economy because people can't service that debt, right? We start getting 4s and 5s, and all of a sudden everybody had to kind of recant their statements, or they say they keep adjusting their numbers higher, right? Like it's always interesting how the prognostication changes in real time. But part of that was, as some of our friends like Chris Cole, Mike Green have said too, is like, if the rates get too high, these corporate entities are going to start defaulting en masse, and it's just going to be an absolute disaster. But the problem is you may be able to call that, but then the timing's difficult, right? You can have a thesis, but then getting your timing right is an entirely different scenario. So one of the things you brought up that I think is interesting is like, when are you issuing that paper? And you create ladders over time. And so it really depends on when those ladders are coming due. And then more importantly, can you refinance or repaper those positions? It's not necessarily can you afford it. It's just in a Minsky sense, it's like, can you roll it over, refinance it? But more importantly, when are those ladders coming due? And does that give you a better sense of when that timing gets pushed back, or when you see inflection points where that timing could be risky?
Yeah, so corporates acted responsibly, unlike our government, of utilizing the really low interest rates to extend maturities. And so, IG space it really extended maturities because they can borrow, 50 years if they really want to, right? So investment grade doesn't have anything in our face in terms of a maturity ladder. High yield, because they obviously can't issue, the market doesn't like to digest really long-term paper for high yield. And so their maturity ladders, kind of start waking up in 2024, and then the meat of it's, 25, 26. So it's like, it's not in front of our face. So if we're going to start seeing defaults, it's not going to necessarily come from inability to refinance that paper. It's going to come from actually, not making money from operations, becoming cash flow negative from actually operating your business. And, but why that wasn't a big deal in 2022 is inflation is good for all those folks. If you borrowed a bunch of money and then, your revenues are going up just based on inflation, maybe your, real value add in terms of profits hasn't gone anywhere, but your nominal has probably gone up just because of inflation. So 2022 was a fine environment for even, let's call it not fantastic operators in the high yield space. 2023, that might actually change, right? We'll see what top line looks like, but I think the surprise might be a massive decrease in growth and potentially inflation, or at least the ability to pass through costs onto whoever you're selling your services to, goods or services to. That is potentially the problem, right? It is actually a massively slowing in the ability to actually continue to raise prices and maintain any sort of margins, and wandering into a slowing growth, potential recession, whatever the heck it is, could actually cause defaults in the high yield space, even though there's not a maturity wall right in front of us. So that's why I'm hyper focused on credit for 2023. Not only is it, I would call it too tight from, kind of technical matters that are abating at this point in time, but also we're going to have to start actually focusing on fundamentals maybe for the first time in a while. And those fundamentals might not be saying great things for credit, especially as we enter the back half of the year.
Just from a pragmatic sense, what do you use to track the maturity ladders? Do you using like Fred data, and what are you looking at? Like, how do you keep track of that?
Yeah, no, they're, mixture of Bloomberg, you can use Fred, like it's actually not too hard to digest kind of total outstanding debt. So culmination of all those sources is kind of what you utilize to pay attention. But yeah, IG, everybody kind of refinanced in latter half of 2020, 2021 to 10 plus year maturities for the kind of like weight of the average issuance. And so again, investment grade is not going to have problems anytime soon from a refinancing standpoint. High yield, kind of centers around 5-ish year issuance, right? So that's why, the meat of the ladder is kind of 24, 5, 6, because they did most of refinancing in, 2020, 2021.
And then, like you said, that gives you the aggregate. And then if you want, you could be a fundamental credit person and start picking and choosing your battles and the credit. The thing you mentioned that it just shocks me that I have to keep reiterating this because you would think it's patently obvious, but we're talking about rates, inflation, recession, growth, all these things, right? They come in waves. And like, if CPI numbers come down, they can come back up. Like if anybody studied like the 1970s, the waves of inflation were crazy. All the intervening years of the 70s, it went up, it went down, it came back up again. And it just seems like shocking to me that I keep having to bring this up is like, if we see inflation numbers come back down, everybody thinks good, everything's great. Maybe rates come back down a little bit. Everybody's going to think like real estate and all these things are great again. But we could easily see like, I can't call the timing, but let's just say the second half of this year, inflation numbers come back up and everybody's going to act like they're shocked and they got caught with their pants down. Well, it's like, it's the most obvious thing historically is everything works in waves. And like, I don't know, like, is that shocking that you have to say that? Like, it just doesn't make sense to me.
Yeah. And I think part of it too is, after prices move up 10% and then all of a sudden your comps are effectively, that new price, like, if it was $100 and now it's $110, it'd have to be $121 to be the same rate. So it's like, just your comps get easier and easier that are going to naturally kind of quiet the inflation numbers for a period of time. And then we'll, see what happens if there is another wave or not. But yeah, no, I would agree that the focus on a month-to-month number is probably misplaced.
Let's talk about this holy trinity, I would say, of correlation, liquidity, and volatility, right? Like they all kind of affect each other. And, what was the more interesting thing, I guess, in 2022, we started seeing correlations rise, obviously, with stock bonds. But even on my walk this morning, I was listening to another podcast. Dylan Grice was on Alpha Exchange, and he was once again talking about correlation and volatility. Like we usually don't see spikes in vol until we see spikes in correlation. But it's interesting that, other people like you and Chris Cole, et cetera, like I think, illiquidity is tied more to volatility than necessarily correlation. But like, how do you square that essentially? Like things were more correlated in 2022 and we saw, medium-sized vol. We didn't really see too many spikes in vol. So if correlations increase in 2023, do we need to see illiquidity before we see a spike in vol? Or how do you think about the combination of those three factors?
Yeah, because I think most folks would say that high correlations cause illiquidity, which then likely causes a significant change in volatility, is like, your wandering path, if you will. And yeah, in 2022, high correlations didn't really cause significant bouts of illiquidity in basically any asset class. Why do I think that's the case? I think probably part of it is active managers were reasonably light on risk in comparative to their historical standards. So people that can quickly adjust their portfolio, were kind of well positioned was probably part of it and had ample liquidity. So that probably muted the impact of high correlations into illiquidity. Kind of the next piece is the amount of passive investing as a total, percentage of all assets is obviously incredibly high. And a passive investor or, investment product, it's just fully invested. Like there's no kind of like mechanics to force it to go ahead and puke assets at any point in time. So that's kind of quieter on that side. And I think there's been a massive increase in private investments and private investments, obviously not needing to necessarily mark themselves day to day. Also kind of provides a little bit of a buffer from high correlations driving massive increases in illiquidity and then potentially, eventually volatility. And the culmination of people being forced to sell things to live their lives. They had a buffer in 2022. People had a decent amount of cash and or ability to, extend credit on credit cards and whatnot. So they really weren't, consumers didn't become necessarily forced to liquidate assets, which can, cause the waterfall. So I think it was the mixture of all those kind of things why a incredibly high correlation across all assets in 2022 didn't really drive bouts of illiquidity that most people I probably would have assumed would have taken place.
Do you think part of that is like you really need to see it in credit markets? You need to see illiquid credit markets or some volatility in credit markets or some sort of defaults or scares to see those true spikes in volatility?
Yeah, no, I mean, I think, credit markets are always going to be the core of, experience of massive illiquidity. I mean, that's what, March 2020 was actually scaring the Fed, was credit markets and treasury markets, frankly, like froze. That's what matters. Like, they didn't really care about the S&P moving 10% every single day. They weren't happy about it, but that wasn't the focus.
Do you think that, how do you think about like the B-REIT and stuff? Like, do you think that's foreshadowing? And especially if we have all of these financialization of markets where we're trying to turn, illiquid, non-granular, products into liquid products, like, and especially on the credit side, do you think that's foreshadowing, or that's just kind of an anomaly with the B-REIT situation?
I wouldn't necessarily say it's foreshadowing, but it definitely, provides a little bit of extra kindling if we ever actually get to a massive illiquidity event, right? So it's like, those types of vehicles likely help, starve off illiquidity events until you get to a place where you can't fight it anymore, and then cause a much bigger explosion than you would otherwise have.
That's fair. You mentioned Japan earlier, and so I have a couple of questions about it. I don't really have too much of an opinion here, in the sense that, like, moving the yield curve control band from 25 to 50, is that just a function of basically having a new head of the BOJ and he just wants a little bit more wiggle room, or is this a sign that finally the Widowmaker short GGB trade is back on and people should be taking advantage?
Yeah, I think it's a little bit more of the latter. The amount of asset purchases that they were doing before they, off meeting made that change was like 5x their normal daily asset purchases. So, I think they were fighting it, and they could sense that they were going to lose, and possibly lose in a big way. So again, from a credibility standpoint, you can't lose. Like, you just change to make it seem like I always wanted to do this. Like, you didn't force me to do it, I wanted to do it. So yeah, I think they're starting to lose a little bit of control, but at the same time, like, as you said, people have been fighting them and wrong for 20 years. So, it's kind of easy for them to bat people back at this stage. So they have some more life within them, like, before, and some tools that they can do to, act like the market didn't influence them to make decisions. They did it on their own whim. But yeah, no, I think they're getting to a little bit of a inflection point in their ability to control the markets as well as they have over this whole period. And I think the main reason is you probably, not only are things wound to a point that it's problematic, but you don't have the monetary and fiscal side of the houses probably operating in line with each other. Because, inflation in Japan is a problem. Like, their citizens are getting to a point where they're probably not very happy, and thus, the people that are elected officials are not very happy, and they're gonna, not want to move in the same way potentially as the monetary side of the house. They're an island, and they import a lot of things, and so it's like it becomes hairy quickly for somebody like that.
Yeah, it's outside of your purview or mandate for what you do at Convexitas, but I'm just wondering, does that short JGB trade start to look tantalizing to you, or is it still like, this is just too hard and you can't predict the forces or pressures from the people running the BOJ?
Yeah, I mean, I'd rather participate in markets that are not 100% manipulated, because I'd like to think I have some edge. I don't have any edge there. Like, I know what the fair value is, and it doesn't matter.
And then just to bring it back out, because you were my go-to when we started seeing the wonkiness in the gilt markets, and it started to affect LDI, and all of a sudden everybody learned what LDI meant. But one of the things that you described it on as a bridge loan, and I thought that was a great way of describing it. It gave me a way to frame it and to think about what actually happened and what transpired and why it was resolved so quickly. So I guess because you have a little bit of background in LDI, especially even on the British side, so can you kind of give kind of quick rundown on what happened there?
Yeah. So, I mean, the quick rundown, we already talked about U.S. pensions, and it was like a great year for U.S. pensions, right? It's not dissimilar over in the U.K. Again, what they care about is, do they have enough assets to service liabilities? If rates are going up, liabilities are falling, and probably their assets too, but all in lockstep and in a fine way. So why it became an issue, say they were 100% funded at the start of the year, and on paper they were still 100% funded at the end of August and at the end of September too, but their assets were not necessarily in liquid things. Everybody, when you have a very stable, low interest rate environment, probably get a little greedy. And over in the UK, their pension liabilities are discounted on a gilts plus linkers curve. So that's treasuries plus tips, basically, type of curve. So there's no credit involved in their discount rate, where the US, again, is kind of like an A or better curve. So it is credit in their discount rate. So in theory, you shouldn't own any credit if you're 100% funded. You should just own gilts and linkers. Everything's in lockstep. But over in the UK, unlike the US, most of these pension plans are still open, i.e. new employee is getting added to that pension plan. They're not going into a 401k type of situation. It's still a defined benefit society. So because the pension plan's open, you may be fully funded with all the people you currently have working, but a new liability just showed up because you hired a new person. So the reason for being a little bit of greedy in those plans is to hope that your assets can outperform your liabilities just enough that you don't actually have to contribute any additional money for that new person that's being added to the pension plan. And they're not going to take massive risk, but they're going to, over time, maybe start taking a little bit of risk. And so the risk was, okay, we're going to buy, some UK corporate credit, even though it's not at our discount rate. Like, I want that extra, 50 basis point spread. I'll buy some high grade UK credit. Then the UK credit market, isn't as attractive as the US credit market. So like, oh, let's buy some US credits. You're adding a little, going from, gilts to credit. Okay, that's adding a little bit of illiquidity. Going from locally domiciled credit to international credit, that's a little bit more illiquidity. And then they started going into privates and infrastructure and things that have truly no instantaneous liquidity. They're off-market instruments. So that became their problem in August and September of last year, that their assets and liabilities were still, call it one to one approximately there. So the actual pension was fine and not being damaged, but when they needed some liquidity to support a lot of the instruments in the derivative space that they had on in their portfolio, they didn't have the natural source of it because they had moved out the illiquidity ladder all the way into some privates, and you can't post privates to the exchange for supporting the collateral for your derivatives. So when things were getting hairy, the Bank of England reached out and said, well, what's the problem, guys? And they said, well, listen, like, we're totally fine. Trust me, we're totally fine. But I need 2 weeks. I need 2 weeks to figure out this story because, they're like, we call Blackstone. They're really happy to buy all of our privates, but it's going to take them a little bit of time to do their needed due diligence, and we agree to whatever haircut that it is to get our cash out. But that's it. We just need a 2-week bridge loan. And they're like, all right, for 2 weeks, guys, rather than selling things, we're going to buy everything on the planet, give you the, headroom to go ahead and figure things out. And then everything's going to be okay. And, they were able to find a buyer for their illiquids in that 2-week period, and then hey, the problem for the moment was solved. But yeah, and I think that most people are very focused on like, oh, the derivatives, mass destruction. Who the heck at 1% interest rates is having 100-year duration in a portfolio, all that kind of stuff. Like that's just folks that don't understand ALM, asset liability management. Like they're not trying to make money in absolute terms. They just want their assets and their liabilities to move in lockstep. So they're going to own what their liabilities are discounted at, which in that case is a decent amount of gilt and linker risk, and that's where derivatives came to play. Their error was not having a liquid portfolio, not the investment strategy in terms of the ability to hedge out those liabilities. It was getting greedy and turning your portfolio from fully liquid to something that's less liquid.
Well, that's why, like you said, the henny pennies of the world, it didn't lead to a cascade of consequences because, like you said, it's a bridge loan for illiquid, mark to market, have assets, and whether they could bridge it over that 2-week period to get better pricing. But you brought back a lot of memories for me, actually, because I realized I vividly remember having this conversation with you while I was in a long layover in Paris at Charles de Gaulle Airport. So like it's bringing back some weird memories for me. But the further nuance of the bridge loan, though, that I think that you highlighted that was really interesting to me is it's a sizing issue as well. Like if you're a very large pension, right, you have either an internal or an external team that are really managing a lot of those liabilities, those linkers, and even some of the derivatives for you. But if you're a smaller pension, you don't get great management on that. So they're getting pulled into commingled funds, and those commingled funds weren't having like the capital calls, like say at the beginning of 2022 or in intervening periods of saying, hey, we need more cash on the books, we need to adjust the book around. It was more like all of a sudden it was like, there's not a problem. Now there's a huge problem, and we're all in a commingled fund together. So we're all going down together. Isn't that part of the nuance as well?
Yeah, no, the pensioners that actually were damaged in that event were the smaller plans that invested via a commingled product, right? Because you're, again, like if you're doing everything in simply managed accounts, their issue was not having enough liquid capital to continue to support holding onto those positions. Because the whole goal here is, you want your assets and your liabilities to match each other, and you just got to be able to hold on, right? And It's much easier to achieve that if you're in separately managed accounts versus in a commingled product, because a commingled product says, hey, we need more, collateral. There's not a natural source to go ahead and achieve that in a commingled product. So those commingled products actually did delever during that event, and probably sold things at potentially inopportune times and actually were damaged. So there's always, all good ideas also need the right operational structure to achieve those good ideas in the best format. And a lot of investment industries and products, a commingled product is often not the right wrapper to achieve your goals.
Exactly. Well, unfortunately, we're running up on time here, and I feel like you and I are going to have an ongoing theme of like we just keep pushing back the food talk to next time. One of these days we'll do it. We'll do a food podcast, or maybe we need to start a whole new podcast. As you know, I've been texting you. It's been interesting trying all these different hummuses from Lebanese, Israeli, and like it's actually made me think about markets at the same time too. Is like the comparison is the thief of joy. And as you know, like in that region, like there's so many different varieties coming, intermingling of countries, from mercantilist economies. It's like, it's almost impossible to compare two hummuses. And I just think of like all the things you and I were just talking about and trying to pull on here is like, there's just so many nuances in markets. And otherwise, I could spend 10 hours talking to you about these things. So trying to cover 5 topics, 6 topics in an hour is probably a terrible idea. But I want to thank you for coming on again, but plug away again, website, LinkedIn, etc.
Oh, you want the www again?
I was just gonna set you up, see if you did it.
Yeah, just find us at Convexitas.com. As I said, my business partner is forcing me to use LinkedIn this year, so there'll be a decent amount of rando posts of where we're attending things where we write things like this, chats. But yeah, please reach out and find us in those two places.
Yeah, and I'm not sure if this will be out before, we're going to be down in Miami together in probably less than 10 days for the week January 30th for all the hedge fund week. If you happen to be down there, say hi, give a shout out. We're happy to say hello, grab a coffee, whatever. Zed, thanks for coming on.
Thanks as always, Jason.
Bye.
Thanks for listening. If you enjoyed today's show, we'd appreciate it if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.